Hi guys, as we continue the alternative investment series, going to go over an old blog that did 3 years ago. So apologies about the out-of-date data, but a lot of it still holds relevance today. I'll put a link in the description below because it does go into a bit more detail into how some of the strategies used and some of the biggest hedge funds that are employed. But we're going to go over hedge funds, going to go over what are them, the risks of them, the pros and cons, the fees, how they differ from mutual funds and ETFs, and how to potentially use them in your portfolio to hopefully make you an informed decision of if they are right for you to potentially look at in a portfolio. So hedge fund is an alternative investment of pooled funds that employs different strategies to hopefully earn alpha for investors. So what do they differ from mutual funds or ETFs? Again, except from the assets that we'll go into later, is that they look for absolute return. So a fund may look for relative return to the benchmark, whilst a hedge fund will look for absolute return. So if the market goes down by 30%, a hedge fund will still be looking for example, 12% per year, 1% per month, regardless of what the market does. What are the cons of them? They're quite risky, as they have different regulatory insights than mutual funds and ETFs, so they can go in alternative assets that are deemed more risky and use different strategies that may be quite complex and out of the scope of the retail investors and professional investors as well. Some of the pros of them is they do add diversification in theory to a portfolio. They can use different strategies to hopefully get absolute return for investors. What are the fees within this? Can be another con. They usually charge a 220 rule, so 2% of the AUM and 20% of the profits. As you can see, compare this to an ETF that can cost 0.05%. It's significantly more, so you are expecting returns from them. In the blog, we've written a number of data that goes over some of the performance of hedge funds versus the S&P 500. Obviously, Warren Buffett did a famous bet against some of the big mints in 2008. How do they differ from a normal fund or the S&P 500? Here you can see the different strategies that are used in hedge funds. A generic example, obviously it does differ on what hedge fund example is used. For example, Bridgewater would probably use more global macro than quants. And this is the S&P 500 and how it's compromised in terms of asset allocation. As you can see, it's very different. Hedge funds use a lot more different strategies in their repertoire to kind of look for returns. So go over a few of the largest hedge funds can invest in and how to use them in your portfolio. So to be used in a portfolio, again, you should be looking for growth or high growth. It's not particularly for conservative investments speaking. So if you high versing investors, an alternative, you should have 25% of your asset allocation into alternatives. You'd look to make up a proportion of that into hedge funds. Again, hedge funds are usually only for high net worth investors, so it may be worth looking to see if you can get into a specific way if you're not a high worth investor that doesn't require you putting in 100,000, etc. on that. There are certain funds that you can use for that. Hope you found this useful. I'll put a link in the description below to the article that reads, because it does go into a bit more information, as this was quite a quick video on this topic. So feel free to go over that at your own leisure, and I hope you found it insightful into what might be useful for you in your portfolio.